Hi there. How do you go about building a stock portfolio and, most importantly, maintain a healthy stock portfolio so that whatever stocks you've invested in, you can be able to see them, enjoy share price appreciation, or even attract dividends so that at the end of it all, you are able to build wealth. That is what I'm going to be talking about in this video, giving you free knowledge which is going to assist you shape your journey in investing. If you are liking the videos I'm making for you each and every day around money and investing, kindly consider subscribing to this channel. Down below, there is a button called subscribe. Click that button, subscribe, join the family, and you won't miss any of my videos. And I will still add it, I'd really appreciate you liking this video as I continue to give you this amazing knowledge for free. Thanks for that. In this video, I'm going to examine this in three parts. Building a stock portfolio is a process, and typically it begins with you choosing a platform where your stocks are gonna be best. That's why in this video, the first part I want to talk about is how do you choose a platform? Secondly, how exactly do you build a portfolio? And third, how do you maintain a healthy portfolio and even start seeing your portfolio appreciate in value? Those are the things I'm going to focus on, and I'm going to discuss in detail so that you absorb all this knowledge. Having said that, the very first step in whichever country you are out there is for you to choose a platform you're going to be utilizing for you to trade. You're going to be utilizing for you to buy and sell whichever stocks. There is some basic things you need to look at as you are choosing a platform which you're going to use to trade. Among the things you need to look at for you to choose a stock market and platform is invest in a market which you understand. Let me give you an example. Right now, I'm domiciled in Kenya, okay? If, for example, I wake up and say I want to buy stocks in Russia, do I understand the Russia stock market? Do I understand the trading platforms in Russia? Maybe I don't, but chances are I deeply understand the investing ecosystem in Kenya. I'd prioritize those because I have an understanding. If you jump and invest on something which you don't understand, you are setting yourself up for failure. And then the second thing is prioritize regulated brokers. Don't give your money or invest through brokers who are not regulated. That's the easiest way of you losing your money. People out here sometimes think that regulated brokers are expensive. It is a bigger expense you putting down a huge amount of capital and losing the entire of it because you're running away from paying a few dollars to a regulated and registered stock broker. Okay? And then the third thing is compare trading fees and account minimums. Out here, each stock, broker, or platform has different fees and account minimums based on your ability. Because remember, I said investing is a habit which you nurture over time. Maybe you have 10,000 Kenya shillings or $100. Maybe you have a million Kenya shillings or 10,000 US dollars. Whichever amount of money you have, look at the trading fees across the different platforms, okay? And also check the minimum accounts which are required in those platforms before you jump on any particular trading platforms. And then the fourth thing you need to check is look at the richness of a given platform. Are they, for example, offering you stocks? Okay? Are they, for example, offering you ETFs? Are they, for example, offering you bonds and whichever other financial instruments out there? Maybe your entry point is stocks, but over time you'd want to diversify to other investment assets. Are they availing you the option of investing in more asset classes? Because I try to think that at the end, you'd want to consolidate your investment through a platform which you know, okay? And then the last thing which you need to look at when it comes to a platform is choose a platform which is intuitive and they have optimal or top-notch customer service. This you can tell maybe when you go to, for example, even Google Play Store and check what are the feedback which people are giving to a given application of a given stockbroker or a given trading platform. Through that, you can be able to deduce if they are supporting their customers or not. Okay? Don't jump on a given platform and yet the reviews are very negative. That you could be shooting yourself on the foot. Having understood elements around the platform, let's now talk about building your portfolio. When it comes to building portfolio is also a process. And before you even think about jumping and going all in a given stock portfolio, first thing you need to do is to ensure you have emergency fund. And the amazing thing is that some investment buses out there or asset classes allow you to also build emergency fund through them. Case in point, MMFs. MMFs allow you to build emergency fund through them because basically they are liquidity buffers. You put your money in MMFs, you enjoy daily interest, and if you need access to your money, you can actually access your money even within 24 hours, 48 hours, basically on short notice. That is the power of utilizing such kind of investments for you to be able to really ensure you start your investment journey and building a portfolio, because you're going to have emergency fund first and then start building on that. And talking about building on that, the second thing you need to do is to choose 5 to 10 quality companies which you'd want to invest in, and also choosing the indexes which are quality within your 5 to 10. Please note, I haven't told you choose 5 to 10 stocks. The reason why I'm saying that is because whichever stocks out there, whichever index funds out there, they are anchored and they are driven by company performances. And remember, share appreciation most at times is anchored on perception regarding how a company is doing, regarding fundamentals from a company, and any other news out there. So, if you don't choose your underlying companies which are quality very well, you might end up reacting or even investing based on sentiments. Case in point, if you go and look at the stock market, see a given stock appreciated by 10% yesterday, and you jump to put your money on that particular stock without understanding the company behind it, that you're going to be making a poor decision. Because the starting point is first selecting the companies you want to invest in, because you are basically being part owner of a given company. After you've selected, then you narrow down to their stocks or whichever investment options they have, okay? And then you can commit your money to that. Choose 5 to 10 as a starting point. Don't go to any stock exchange or stock market and then purchase 20 assets at once which you don't know, because you need to know what you're doing and really believe in that. Start small. Maybe over time you can be able to expand for you to reach even a higher number of items in your portfolio. And also, I talked about the broad market index funds, because this really assists you be able to diversify your risk. Thinking about the broad index funds are, for example, mutual funds, ETFs. Basically, behind the scenes, it is a collective of investments. In the S&P, there is ETFs. Even in other stock exchanges, like, for example, the Nairobi Securities Exchange, we also have mutual funds and even ETFs through which you can invest in as a starting point, because already they have low risk based on the constitution of the portfolios which these individual ETFs have. And talking about that, the third thing which you need to do, that's the why I told you, select 5 to 10 companies. You can even start with 5 at the end, is basically to assist you diversify your risk. Out here, there is no investment that is absolutely risk-free. Even if things like, for example, treasury bills and treasury bonds have a risk, it's just that their default risk is very low, but still they have an element of risk. And in the stock market, talking about the risk being higher than even government securities. That is why you need to diversify. Don't put your entire investment in one sector. As you are selecting your quality companies, select the companies from different sectors, okay? Case in point, using Nairobi Securities Exchange, we have different sectors: banking, telecommunication, manufacturing, service industry, you name it. In case, for example, business is bad in the banking sector, chances are companies like Safaricom, which are telecommunication companies, are going to continue thriving. In case business is bad maybe in telecommunication companies, okay? Companies in manufacturing, maybe like the BATs and the likes, are going to continue thriving. That is why you need to diversify, and that is going to be a very powerful tool for you right from the onset of you constituting a portfolio. Don't put all your eggs in one bucket. Okay? And then the fourth tip for you when you are building a portfolio is that don't be in a rush. Don't go out there looking for loans to pump loans in the stock market. That is not a wise move because you might even get in a high interest debt. Go slow but sure. You can form a cadence of you putting regular amount of money in your portfolio, basically starting small and adding to your portfolio, whether you are adding volume of stocks which you have bought initially or even adding more stocks which are quality. That is an element called dollar cost averaging, where you can say, for example, each and every month you are plowing 10,000 Kenya shillings or even $100 or $1,000 to your portfolio each and every month, in case that is the amount of money you can unlock on a monthly basis. Don't go out there, for example, getting a loan of 1 million shillings, right? Or even maybe 10K US dollars and pumping all of it in the stock market or the stocks in your portfolio. That won't be wise. What if you pump and then the stock market crashes 30% and your stocks are hit bad? It's going to mean you're going to have very severe capital depreciation, yet you have a debt which is high interest that you're supposed to be paying. So start small, use dollar cost averaging, and then see how you can continue scaling up. And then the last tip is that develop a strategy, stick to it. And I'm saying so because out here people think investing is magic. It isn't magic. You need to start small, refine how you are going about investing, develop your own strategy right from formulation of the portfolio, stick to it, keep testing as you refine a strategy. And then that is what is going to work for you. Don't copy people out there just because, for example, you had Warren Buffett made money through doing 1, 2, 3. You are not Warren Buffett. You have your own unique reality. Or even so, the stocks which Warren Buffett invested in are not in your market. So start small, start the way you can, as long as you've done fundamental and technical analysis to select quality companies to invest in, and then continue building bit by bit based on that. And talking about building, how exactly do you go about growing your portfolio to ensure you have a healthy portfolio at all times and you grow a portfolio that is minimizing your risk while maximizing your returns? The very first thing you need to do is reinvest dividends. Don't be in a hurry to cash out your gains, whether it is share price appreciation or dividends, which mature companies typically pay each and every year, whether it is through the interim dividend or the final dividend. Don't be in a rush to cash out. And I'm saying so because out here wealth is built through an element called compounding, whereby you have a longer investment horizon. You make you have maybe share appreciation or even dividends. Keep plowing back to your investment. That way it's going to enable your investment grow exponentially, and you will build wealth in a way that is very sustainable and more rapidly. Okay? And then the second tip for you to grow your portfolio is review your holdings on a standing cadence, whether it is once or twice a year. Please note, I've chosen a bi-annually or annual cadence. Reason being, I'm not a pro champion of people betting in the stock market. Don't bet. If you are waking up each and every day to look at the price of shares and then execute change in purchase and selling of different shares in the stock market, you are basically gambling. That is why you need to have a longer time horizon once you constitute your portfolio. Don't be shooken by any movement in prices. Out here, markets crash, but also it's already proven when markets crash, again, markets recover. And over time, investors who are able to operate without emotions, without sentiments, without reacting to fear, anxiety, are the ones who are going to make money. That is why you need to have a standing cadence, maybe once a year or twice a year, of you looking deeply at your holding to decide the next course. Don't go out there looking at your holding every day or even every week. That is you wasting your time. Remember, even if you try to cash out, there is fees which you're gonna incur. So hold for at least half a year or 1 year before making any changes, okay? And then the third thing you need to do for you to be able to grow and improve quality of your portfolio is only add stocks if they are adding to quality or diversification aspect in your portfolio. Just because a share of a given company is rising rapidly and you already have companies in that sector in your portfolio, don't rush to buy additional shares of the same sector without really understanding the company health or gaining deep insight on a particular company. That way, you're going to be reacting based on market sentiments. Because already you have the sector in your portfolio, chances are whichever benefit that company is deriving are most likely going to trickle down to that particular sector companies, unless the company is having absolutely exclusive advantage, which is rarely the case. So only add to your portfolio in case an additional stock you are looking at is adding to diversification of your portfolio or quality of your holding. If not, don't rush to add. Okay? And then the third thing which you need to ensure you look at while you are growing and consolidating the health of your portfolio is by you ensuring you trim positions that no longer fit your investment purpose. Remember, you had a strategy, you had a thesis when you are starting to invest. Okay? So during these regular reviews, don't just look at adding to your portfolio, also trim positions which are not working for you. Simple as that. Okay? If a company is not working for you or a company health has really deteriorated over time, during your annual review, don't hesitate trimming those positions which are not working for you, because those poor positions are the ones which are going to increase risk in your portfolio, thus reducing your return. They're going to pull down the other stocks which are doing well in your portfolio. And then the fourth thing you need to do, and also very important, is that you need to continue learning about business, valuation, market cycle, and anything relevant to stock market and economics at large. And I'm saying so because over time you'll come to understand the money you're going to make in any investment out there is most likely proportional to the knowledge you have in that sector and how you are behaving rationally in that particular investment. That is why learning doesn't stop. Continue learning, continue absorbing fundamental of these companies, of the market, of the sectors, so that even during your reviews, you are having objective reviews as opposed to you working or reacting emotionally. That way, you will be able to choose a good trading platform, build your portfolio, and most importantly, work at seeing your portfolio grow and have a healthy portfolio. Guys, what do you think about this video? I hope you've gotten a blueprint or guide which you can utilize for you to be able to start building a stock portfolio, and most importantly, to grow a stock portfolio to ensure you see your capital appreciate and also you benefit from the benefit of compounding for you to grow your wealth over time. Cheers, guys. I look forward to share with you other amazing videos next time. Bye bye, and y'all take care.